Hello, and welcome to a special edition of Market Insights. My name is Evan Coffey, investment analyst here at Great Valley Advisor Group, and today I'm joined by two esteemed colleagues of mine here at GVA, Chief Market Strategist Eric Parnell and Director of Asset Management Eric Howe. I think we've got a lot of good things to talk about today. Eric, it's great to have you on here as our team's specialist in private markets and alternatives, and I think it's really well timed considering we've had no shortage of headlines within the private markets and private credit space. Many of them have painted a negative picture, but some more recently, as we've discussed, have started to shift back positive. So first and foremost, I want to share with our audience a bit of a timeline of some of those headlines that sparked the financial media world this year, and then open it up to you to gain your perspectives and opinions as to why things may not be as doom and gloom as financial media have made them to be. So to start, at the beginning of the year, credit came under pretty heavy scrutiny, and I think that this was because of its just rapid expansion, and then ultimately a market that became less forgiving. From there were reports that BlackRock froze redemptions on its private credit fund in March after receiving massive investor withdrawal requests. Analysts were flagging that roughly 40% of credit borrowers had negative free cash flow. And then you had the whole software and SaaS tie-in, where essentially non-traded BDCs lent aggressively to middle market software companies. And the pitch was rather straightforward. It was, hey, these are high margins, recurring revenue, and the idea that cash flow was going to be rather predictable. This was until the idea that AI would commoditize this space, which that narrative grew rapidly, and I think that trickled down into the private credit space. We saw in early April, news broke that Blue Owl was forced to limit redemption from two of its private credit funds after facing heightened withdrawal requests. Investors in the $36 billion Blue Owl Credit Income Flagship Fund asked to pool about 22% of shares in Q1. This was up from 5.2% in the previous quarter. It wasn't until early April where I feel like the narrative started to shift back positive. We saw that Goldman filed a document with the SEC reporting that redemption requests were below 5%. And then you sent me a similar article from PIMCO saying that their interval funds met investor redemption requests as well. So, you had some positive news. More recently, on May 5th, an article was released titled that KKR says that the market distress is basically overblown. KKR co-CEO Scott Nuttall stated that the perception of volatility in private markets was different than the lived experience. So that's kind of the rundown of the timeline of some of these major headlines we've seen. My question to you is threefold. First, how much of this is noise? Second, I think that there have been a lot of people and news outlets that have drawn or tried to draw parallels to the GFC in 2008. So what are your opinions on that? And then third, and maybe most importantly, what education is needed for investors to know what to avoid and where to allocate?
Eric, Evan, thank you for letting me join in the first edition of May Market Insights with me on board. I really appreciate the layup question you gave me as a three-part right out of the gate. But I think you're right. I think the first 4.5 months of the year, we can agree that clients going to advisors coming to GVAM, the headlines have been private credit in the first quarter, the Iran war, its effects on inflation in the second quarter. Eric Parnell had a great advisor meeting yesterday in which he referenced the financial media, how they live on stress. It's a little bit different from the Hollywood adage. But they really invoke panic in viewers in order to have them come back and continue to watch. We both remember COVID. We were glued to the TV, watching the numbers of death spikes every day. Didn't really do anything except create more fear. So when there's fear, you should really be looking towards fundamentals. And I think the first thing we should do is look under the hood. Let's see what the real comparisons are. I think your first point was to the GFC crisis of 2008. Eric and I both lived through it. You were still a young buck at the time. But I think there are similarities between the two instances in that it really shows the greatest difference between the two. And I know that sounds a little bit weird, but let's kind of get into it. In 2008, depositors were the ones that were financing loans for mortgage-backed securities through banks. Banks were 30 to 50 times levered. Bonds themselves became very liquid. Once there was a hiccup in the mortgage market and the housing market, many of those loans were lent at 5% equity, 2% equity. Some of them were 0% equity. Some of them were negative equity that included closing costs. Once there was a small market move in those securities, you ended up having investors just handing back keys. Banks ended up taking back the loans. The issue became the banks now all own the loans. They're all 30 times levered. You have a liquidity and insolvency problem. The depositors had 100% access to their funds, which kind of is the same mismatch that we see now that people are talking about in the market. But the main difference is investors, right? We don't have depositors. We have investors into credit funds, right? The second thing is leverage. These funds are only levered 1.2 times instead of banks levered 30 to 40 times, right? So you're not going to have the same scale of investors running for the hills as they think they're going to be going into negative equity. Thirdly, you have, which I think is the greatest piece of the interval evergreen type structure, is the 5% redemption clause per quarter. There's one of our great lawyer friends, works a lot in the financial product structuring community. He has a Yeti mug. Ours says GVA. His says 5% is a feature, not a flaw. And I really do believe that, because back in 2008, when I was a portfolio manager at a large investment bank, there was no 5% hurdle. There was no 5% governor for somebody that has driven a golf cart and it only allows you to go 20 miles an hour. Capital leave it in the market is only 5% per quarter. And so your first notion was that, is it noise? We haven't really seen the noise in the market, and I don't want to say, we are the Instagram scrolling type Gen Z flipping through, our minds can only last on one thing for 2 seconds, but we're already onto the Iran war. We haven't really heard much about private credit. PIMCO's PFlex fund came in under 5%, so we'll see in June if the narrative is still there that there needs to be redemptions. That being said, I feel like the structure is sound. We are entering a new credit cycle, right? And I think Eric probably can share some better lights on where we sit in the credit cycle, because there is still credit risk inside of these sound products that are out there.
One of the things that is a common challenge for investors is that they're always fighting the last battle. And it's easy to think, because it was 18 years ago now, that we are on the precipice of another financial crisis incident. I mean, it was a calamitous situation around the housing market, as Eric talked about, that plunged us into the financial crisis in 2008. So the propensity of investors is to want to try to fight that last battle and to think that the next threat is going to come from those same risks. But the reality of it is that we are in a very different place in capital markets in 2026 than we were in the mid-2000s. One of the features that we had at the time in the world was we were moving towards globalization, and we had access to cheap goods, and commodities were being shared all around the world. We were inviting China into the World Trade Organization. The Cold War had ended, and there was relative good relations with Russia. The world was cooperating. But that's not the world that we operate here in 2026. The environment that we're in today is a world where we're seeing greater spheres of influence, disglobalization, if not outright deglobalization, and a world where countries and these different spheres are looking to hoard resources. All of these forces are inflationary. They're not deflationary. What defined the financial crisis was a deflationary event. These are more inflationary forces, and they're likely to accumulate going forward. Higher indebtedness across different countries, and a greater price levels that we're going to have to deal with. Those are entirely different forces that are likely to drive the economy and drive markets, and really lead into the need and the want for investors to get allocations to areas of the market that are not easily captured through public market exposures. And that's one of the reasons why we have these types of private strategies, which you specialize in.
Yeah, so let's get into the second and kind of third parts of that threefold question. I think that a key piece that I want you to hit on is the educational piece. This is a bit of an esoteric side of the market. So why don't you open that up for us? Those high net worth clients, what do they need to know?
Anecdotally, the redemptions that you spoke about in the open were coming from the wirehouses overall. And the wirehouses, as you know, is mostly the high-end ultra high net worth clients that are going through your big brokerage firms. The endowment funds, the life insurance companies, they're going direct into the market, so they are not going through a wirehouse to access the product. What is very important is the due diligence that needs to go into each and every fund in the universe. There's a saying in the alternatives that, alternatives isn't an asset class. It's actually a universe of single investments. So what we're looking for when we're doing due diligence is who the manager is, what their niche is, how much leverage they're using, what's their distribution rate look like, what is their sector penetration, that they're not all in software or they're not all in the mortgage type backed securities that we had in 2008. So it's very similar to what you guys are doing already in asset management, sitting down, understanding what our investment partners are doing for you before they actually enter into your models.
Yeah. And then finally, I want to hit on, where and how should investors be allocating?
Allocating in the private equity world, in the private credit world, there's something called vintages. And that's basically just like a wine vintage is the year that the wine was bottled. It's the year that the fund was announced. So you kind of have two ends of the spectrum right now. Credit, we're entering a new credit phase, as Eric just said. You don't want to go into an old credit fund that is an evergreen structure because you still have loans on the books from 2020, 2021, 2022. So you would be looking more towards a newer credit fund that would be launching later this year that would be able to take advantage of the opportunities that may present. On the flip side, if you have something like real estate, as rates are starting to rise, you saw today the borrowers are kind of shifting down towards 10-year adjustable mortgages instead of 30-year fixed. You want to be looking back into evergreen funds in real estate that were actually vintaged in 2021, 22 when rates were very low. So as interest rate rise, you're already locked in on a rate and you're going to be able to take advantage of the inflation piece of the portfolio.
Yeah, I think that's really helpful in giving us clarity into, as I said, a somewhat esoteric alternative investment. The next thing I want to get into is, something that we focus on as a team as a whole, an economic factor that I think you both watch closely, maybe for different reasons, but it's something that is very prevalent right now, and that is the interest rate environment. This week marks the first full week of Kevin Warsh's term as Fed chair after succeeding Jerome Powell, and frankly, the economic backdrop is not one that I think that the, dovish White House agenda was looking for. Last week, we got two key inflation readings, both CPI and PPI. I think CPI was more prevalent in that, it was the highest reading since May of 2023. Headline came in at 3.8%. Core, excluding volatile food and energy sectors, came in at 2.8%. And I think that much of our audience would say that they've seen the toll that the conflict in Iran has taken on prices. The national average for a gallon of gas is over $4.50. And yes, while the U.S. is more insulated from energy shocks than our European and Asian counterparts, it's still something that the general public is feeling. Taking a look at the CME FedWatch tool, there is no longer a probability of cuts in 2026. And if we game it all the way out to July of 2027, we actually have the same probability for a federal funds rate at 5% as we do 3.25%. So I think we're moving back into or maintaining an era of higher for longer in terms of the federal funds rate, but a lot of growth estimates have been revised down. And jobs data has been rather weak, especially if you look under the hood and you strip away sectors like education and healthcare, which tend to be the engine for jobs growth. You throw in a 10-year that's above 4.5%, and it sounds like I'm mixing a stagflation cocktail here. So, Eric, I want to turn to you. I know that you've made a lot of recent comments to us and the team, kind of saying, hey, this isn't really a 2008 we're living through. This might be more a 1970s stagflation era.
Yeah, no, it's the conditioning. From 1981 to 2022, we were in a 40-year bull market for bonds. And what does that mean? Interest rates were moving steadily lower over that time period. And that afforded the Federal Reserve the flexibility to lower interest rates whenever and as much as they needed to in order to stimulate the economy. If we saw economic weakening because of the pricing environment that we were in, because of globalization, the Federal Reserve had that flexibility to support the economy. Well, 2022 was a warning shot across the bow, and I think as we go forward, we're increasingly going to be operating in an environment where the bias is going to be for the Federal Reserve to have to raise interest rates as opposed to lowering interest rates, because the inflationary pressures that we've started to see culminate in 2026, they've been lingering under the surface for the last few years, really going all the way back to 2022. And if oil prices continue to be high, if we continue to see, the solid demand environment underneath that, there's some of those higher input prices, some of those higher commodities prices, we're seeing a spike in nickel prices, that's going to be a battle that the Federal Reserve is going to start to really have to fight in the late 2020s, and it could continue into the 2030s. A higher interest rate environment as opposed to a lower interest rate environment, which I also know has implications in a lot of the work that you do on the private market side as well.
I mean, absolutely. It has effect both public and private, and your past life as a professor, you'll understand this comment that I'm about to make, is that Paul Volcker is championed as one of the best central bankers of all time. 1970s, where you just alluded to, you had the Iran embargo, oil prices spiking, energy spiking. They say history doesn't rhyme, or history doesn't repeat, but it certainly rhymes. And what you're thinking about going on in the markets now, we're starting to see an uptick in inflation while we're having an issue with Iran. Kind of similar. In that, drawing back to my last point on allocation, as interest rates rise, right, you're going to have property values, getting loans to property values is going to be more difficult. The evergreen structure of real estate will actually allow you to go back into investing in a 2020, 21, 22 vintage evergreen fund where that funding is already locked in. So there are some ways that you can kind of move around the markets. On the private equity side, you may not be looking for, the last 15 years we've benefited from multiple expansion, right? In rising rate environments, you're not going to have multiple expansion, right? You're going to have a little bit of compression. So if private equity companies are looking for 2 and 3 times exits, they're going to need to grow EBITDA at 15 to 20% in order to get those, returns, instead of just banking on, multiples going from 6 to 11 where they are now up to 13 or 14%. So I think there is kind of a crossover there. We're both going to be kind of looking at the same thing. The public markets and the private markets, they're stepbrother and stepsister. They kind of live in the same house together, with the introduction of evergreen products, making it available to the high net worth and the retail investor. I think it can be used in a portfolio where if you're getting a little bit skeptical on equities, if rates are going to start to rise, multiples start to come in, there are some places you can park your cash.
Yeah, and I think that you both made great points there. And Eric, you talked about spending, and the final point I want us to wrap up here with today is spending in a different way. We're about through with Q1 earnings, and something that you and I have both written about recently is AI CapEx and infrastructure. 4 of the world's biggest hyperscalers are set to spend $700 billion in 2026. This is expected to be $1 trillion in 2027. As demands for physical assets needed to build data centers and AI infrastructure like buildings, equipment, as those demands increase, we're going to see more and more dollars spent. And much of the spending is, being financed through debt. And the point you raised in your article, Eric, is that the idea that the capital isn't really the problem. And instead, the current infrastructure to accommodate the spend is the problem. Between power availability, grid interconnection timelines, equipment shortages, permitting bottlenecks, these are all limiting factors you wrote about. So, infrastructure has historically relied on public spending, government spending, and it seems like at this trajectory, this simply won't suffice. So my question to you more broadly is, how do private markets tie into this, and where are areas of opportunity for investors?
Well, first, I thought it was interesting that you and I both wrote an article about 2 different topics that tied together without even realizing we were doing it. So I thought that was pretty cool. So it lets you show that this is actually on the forefront of analysts' minds. As far as it relates to actual infrastructure, I guess we can go back to Volcker. Volcker tackled the inflation, the stagflationary era first on the demand side by raising interest rates quickly. The second thing that followed was the supply side, where they were bringing down oil prices. If you look at infrastructure as a whole right now, the funds that have been coming out are actually more dedicated towards Asia and Europe. That is because there's so many regulations in the United States where it's very hard to have public-private partnerships. Europe went into more of a alternative type wind type energy, biofuels. We didn't really see that uptake here. So we need to upgrade our grid at some point to keep up the AI demand that's out there, in addition to just our country as a whole, relying more and more on electricity.
Yeah.
So I think what will happen is, like we saw in the 70s, if we get to that point, the politicians that are in office right now are really looking towards regulation. I think you'll see regulation loosen in the coming years, sooner than later, I would think, to allow more private money to flow into our infrastructure, because I think the number between now and 2035 is that we're $3.7 trillion short as a country as a whole to provide this infrastructure. So that gap is going to need to come from somewhere. So very similar back to the GFC in 2015, private equity, private credit funds stepped in to fill that gap. I think we'll see that same thing happen again with infrastructure.
Yeah, and I think it will be interesting to see how this recent, NextEra Energy, Dominion Energy headline, plays out, as it could provide a framework for, utilities and energy moving forward here in the United States. But with that, Eric, it was great having you on and your perspective on private markets. I think it was really clarifying. Eric, as always, it's great to talk markets, talk shop with you. Absolutely. And the broader economy. And thank you for joining us for another edition of Market Insights. We'll see you next time.